Hey everybody, welcome to my channel and welcome back to my subscribers. This is where we talk about money, saving, and turning your hard-earned cash into wealth-building assets. This is Bald Guy Money. I am Bald Guy. Let's talk money. Today our topic is the impending stock market crash I hear everybody talking about, especially this guy. Somebody who really inspired me in my 20s, Robert Kiyosaki. He's really calling for a major crash. And what we're going to talk about is simple. I'm going to talk about some hard truths regarding the stock market, some key metrics, as well as where the smart money is going to go to seek refuge once the crash happens, or as I call it, a correction. Is this financial advice? I hope you all said no, because no, it's not financial advice. This is educational, if anything, and no matter what you're invested in, you absolutely need to watch this video to the very end. And as a favor to me, please hit the like button, show some support for the channel. It really helps me reach more people. The channel has been growing, so I'm really counting on you all to help me grow it a little bit more. I do have Instagram now too, and anybody that's interested in following me, you can follow me at bald_guy_money. Follow me there for more content, including a glimpse into my private life, if anybody's interested in seeing what that looks like. And if you're interested in cars, please check out my friend's YouTube channel, 710 Garage. Here's his logo, 710 Garage, because here we're all about positivity and lifting people up. Okay, so if you saw my last video, I talked about a real deal on the stock market, and that is Alibaba. Go back and check it out if you haven't seen it yet. But in that video, I showed some pretty sobering statistics about the stock market that motivated me to make this video because I really think you all need to be aware of what is going to happen. And that specifically covered the PE ratio analysis that I did of the market versus the average since 1950. And that analysis actually made me dig down deeper into a few other metrics, and I'm going to share that all with you in this video. So, as a reminder for you all, the PE ratio is calculated by dividing the price per share by the annual earnings per share. And what this basically shows is how investors value a company versus their earnings. So a high PE ratio usually indicates a company is overvalued, and the reverse is true. A low PE ratio usually indicates that a stock price is low relative to its earnings, and there are exceptions, but really very few. And this is a basic indicator that, you know, anybody who's entry level into investing probably should learn a bit about. Now, now I want to show you this. Please bring up the first visual. Okay, so when benchmarking historic performance versus where we are today, we see that the PE ratio of the S&P 500 is currently 71% higher today versus its average since 1950. And this is a major concern for me because of the way stock market cycles have performed over the last 20 years as a result of the way bureaucrats are managing the world economy, fueling major booms which are followed by major busts. Now, there's a lot to unpack there, but let's start from what the consequences are first, and then I will explain why it's happening. So let's pull up the next image. So when people look at the stock market, they see this, an amazing run-up that has paid for champagne-fueled wild nights on Wall Street, as well as many retirement funds. If you look a bit closer though, you will also see a couple pretty strong market corrections caused by the dot-com boom at the turn of the century, and then the housing bubble in 2008. And you may wonder, we have been running up the stock market pretty high. We have to be overdue for a correction, right? And my answer to that is an unequivocal yes. But how close we are to experiencing the correction, and will it be the world's largest correction, as Robert Kiyosaki says? I have the answers right here, so pull up the next graphic. Okay. Here you can see the average PE ratio of the market since its inception. Why I like looking at this metric is because it accounts better for inflation, as rising prices should partially offset a run-up in stock price, better illustrating how over or undervalued a company is, or in this case, the S&P 500. When we take the 2000 and 2008 crashes into consideration, we can see here major spikes in the market's PE ratio, which were unsustainable and resulted in the crashes we know today. But what's worth looking at is that today's average PE ratio is much lower than that of the previous crashes, and I have a theory as to why. While making this video, I went onto the Google machine and typed in record earnings, and the results I got were absolutely stunning. Do it yourself, really, because you'll be shocked at just how many companies are experiencing either record high profits, record high earnings. It was really astounding. And despite a massive run-up in the stock market, let's pull up the next graph. We're not yet seeing those numbers translate into insane PE ratios because of how much prices and earnings themselves are running up due to what I see as unprecedented levels of inflation. And that is directly caused by the massive increase in the money supply we are experiencing right now. So, what are the implications of that? Here they are. Number one, the stock market is overvalued right now. Nobody can really argue that, as all experts agree that there is a correction event coming because of the high value of the stock market. Number two, the stock market, at least from my point of view, is not as overvalued as it was in 2000 or in 2008. And the reason for that is because of the high inflation we are experiencing right now, which is driving up the costs of goods and services, meaning that company valuations, although high, are somehow more or less justified because of the increased earnings they're experiencing driven by inflation. Now, again, I'm not saying that it's 100% justified, but it's more justified than they were, for example, in 2000 or 2008. The third point is that, from my point of view, as a result of that analysis, we can expect about a 25% pullback when the market finally crashes, or as I call it, corrects. And the last point is that I don't expect the biggest crash in history, as Robert Kiyosaki is expecting, because the inflation rate has been so high recently that, again, the valuations of the company, although not fully justified, are more justifiable than they were in 2000 or 2008. And just to be perfectly transparent on that third assumption that I made, that the stock market will pull back approximately 25%, well, I just want to show you exactly why I'm thinking that. So pull up this chart. Okay. So as you can see, before the massive run-up that happened, basically, let's call it during C19 times, we had a pretty healthy, what I would say, PE ratio on the market of about 25. And my assumption is that that is probably a good equilibrium point that we will pull back to, and that is where from 33.54, if we pull back to the 25 level, that will result in about a 25% correction in the price of stocks. So now that we know what I think is going to happen, let's briefly cover why it's happening and what to expect once the crash or correction actually happens. So the first thing I want to highlight is that for major banking institutions, the price of borrowing money is basically zero. It's free money. And this is a major problem that is contributing to the situation we have right now. Pull up the chart on the federal fund rate. Okay, there it is. So as you can see, the federal fund rate is and has been near zero since about 2008, since the housing bubble. But we know there's no such thing as a free lunch. And the major consequence that this particular policy is having on the market is that people are not able to earn money anymore on savings accounts or on bonds, specifically treasury bonds, which actually used to be a pretty good bet if you wanted to invest your money somewhere safe in order to beat inflation. And basically those things don't exist anymore. So what are people forced to do as a result? Well, of course, they're forced to invest in the stock market. and they park their money in the stock market seeking returns that can beat inflation. Now, are low interest rates forcing people to invest in the stock market? Is that a policy that's done by design to push money into the stock market? Well, I personally tend to think it is, considering the fact that Wall Street has a very big lobby in Washington. However, I don't have any proof to back that up, so what I can say with absolute confidence is whether or not it's intentional, it is 100% leading to this boom and bust cycle that I was mentioning earlier and that we've basically been experiencing since 2000. And when the bust happens, and we've seen this time and again, the smart investors seek what we call safe havens. And I've mentioned this before, but the two assets I'm really counting on to benefit from this crash or correction are gold and Bitcoin. And I think a lot of investors will liquidate at least portions of their investments in equities and put their money into gold and Bitcoin. And with the equities market valued at over basically $100 trillion, that means that there's going to be a lot of money seeking refuge in relatively smaller markets. Bitcoin being about $1 trillion market cap, and gold being about a $10 trillion market cap. And when all of that money, and I'm not saying it's going to be the whole value of the hundreds of trillions of dollars that are invested in equities, but it is going to be a significant amount. And what I expect is that the prices of those two things are going to increase. They're going to increase very sharply, and it's going to happen within a very short amount of time. So basically what I really want to get out and get this message across is that this whole video, this is a message basically for index investors. People who buy the S&P 500 index. I really just want to say, do some research on this topic. Make sure you're hedged against the coming correction, and make sure you're taking advantage of opportunities out there, specifically looking into the potential of increases in the price of gold or Bitcoin. In addition to that, even if it's not buying those two particular things, maybe parking some money on the side, taking some profits now, and being able to take advantage of better prices that are probably going to be right around the corner once the correction happens. That's it for me. Please check in the description for the links to all my data sources. Please drop me a like and a comment if you have something to say. You can always count on me to respond to your comments. And as always, I wish you happiness. I wish you all success. I do hope to see you in the next one. Ciao.